Okay, so let's look at the first one, basis. Again, this is our cost. So basis. Pretty easy when we talk about purchasing something, right? It's whatever we paid for it, as well as the cost to get it ready for use. So just like with financial accounting, if we had to pay to ship it, if we paid sales tax, if we had to pay to have it installed, if we had to pay to have somebody inspect it, all of those costs would be wrapped up into our total cost or our total basis for the asset. However, it can be different depending upon how the asset was acquired. If it's inherited, so it's possible that you could inherit something and then use it in your business. Now remember, we're talking only about business property here. We're not talking about personal property. I'm not talking about, grandma leaves you her house and then you live in it, or you sell it, it's a personal house. I'm talking grandma leaves you her house and then you decide to rent it out. Now it becomes a business, right? Okay, so if you inherit it, generally the fair market value, therefore the beginning basis of that asset, the beginning basis is generally going to be the fair market value at the date of death. Even if grandma bought that house back in 1970 for $2,000 and now it's worth $1.7 million, the basis in that property when you inherit it is $1.7 million. That's pretty cool. That's called a step up in basis, because you've now avoided tax on $1.7 million minus the $2,000 cost for it. Because when you go to sell it, that's going to be your basis. So now your gain is going to be a lot smaller for it. So again, this is just for business property. So the date of death of the deceased. If it was converted, this gets a little bit more confusing here. So if the property was converted from personal use property to business use property, the cost basis is going to be whichever is lower, the fair market value or the cost at the date of conversion. So think about this. If you had a house that you used personally, this actually happened to me. I have a house that you used personally that you couldn't sell. It's miserable. Mine was in Clear Lake when we moved down to Ames. I owned that house for 3 years more than I wanted to. So it's awfully tough paying 2 mortgages, so what did? We decided, well, we've got to rent this property out. So we converted it from personal use, which it was our personal residence, into business use. It became a rental property. So that's kind of the concept here. So when it's converted from personal use to business use, the cost basis is going to be the lower of the fair market value or the cost at the date of conversion. So whatever the fair market value is when you convert it, or your cost at that time. Your cost would be whatever you paid for it, right? So generally speaking, if it's real estate, that fair market value is probably going to be higher, but you have to use the lower of the two. Well, not cost, fair market value. Lower the fair market value or the cost of it at the date that you converted it. If that makes sense. Yeah, what you paid for it originally. Chances are that's, if it's, like I said, if it's real estate, it's going to be the cost. If it's something else like a car, it's probably going to be the fair market value. It's probably going to be lower. So you're getting the detriment in that situation. They're not giving you the higher amount, they're giving you the lower amount of those two. Now, this doesn't happen very often anymore because they changed the rules. If you trade property, it used to be that you could trade, I don't even know anymore if you can, it used to be that businesses would trade different types of property. Like if you had a rental property but you wanted an office complex, you could trade it with somebody else, and you got to delay any gain by doing that. It was called a 1031 exchange. They limited the rules on that a few years ago. So that's what they're talking about here. Property is acquired in a non-taxable exchange. That's a 1031 exchange. The depreciable basis in that case, so the depreciable basis of an asset received after a trade-in, so what you're valuing what you're receiving, would be the cost of the new asset less any deferred gain on the old asset. So remember how when we did the, was it the charitable contributions, where we're making that adjustment? I can't even remember. That was just earlier today. What were we doing? I think it was charitable contributions, where we reduced it by.
Yeah, it was charitable.
Yeah, where we reduced it by the gain. So same concept here as that. So depreciable basis after the trade-in, the cost of the new asset less any deferred gain on the old asset. So what you're essentially doing there is you're attaching the gain that you should have recognized. If you had sold that property, you would have recognized a gain. You are now attaching that gain to the new asset so that when you dispose of the new asset, then you're going to pay the tax on that gain. So you're just moving it from one asset to another in that case. So this table kind of shows you, it's a brief summary, depending upon how the asset was acquired. So purchase, that's the easiest, right? We buy it, it's whatever the cost was. Converted from personal to business use, the lower of either the fair market value, lower of the cost of the item, or the fair market value at the date of conversion. Non-taxable assets cost less the deferred gain on the old asset. Inherited the fair market value at the date of the decedent's death. Okay, so I mean that's pretty easy. The fair market value and the cost of the asset, if you purchase it, that's pretty easy as well. Let's look at a couple of examples. We got Ashley bought a computer for $2,500 to use in her sole proprietorship business. She also inherited land and a building from her father. The land had a basis of $10,000, so her dad bought it for $10,000. Fair market value was $18,000 at the date that he died. Building had $150,000 adjusted basis, so that means that there probably was some depreciation that happened. Maybe her dad had a business, or maybe it was a rental or something like that, and a $300,000 fair market value at the date of his death. She's now using the land and the building for her office. In this case, what she paid for the computer is a depreciable basis. The building's depreciable basis is $300,000. So that's $150,000 of gain that gets to be avoided, right? Plus she gets, her depreciation deduction is now gonna be bigger, right? If you're depreciating $150,000 versus $300,000, that $300,000 is gonna be a higher depreciation deduction, right? Because it was inherited, it was stepped up. The land, now land's a little bit different. We don't depreciate land. Just like we don't depreciate it for financial accounting purposes, we don't depreciate it for tax purposes either, but we do have a basis in it because at some point we're gonna sell that land or dispose of it somehow, and we have to have a basis when we do that. The land also gets a stepped up value. So it's gonna be the value at the date of death. She also converted to business use an old van. So this might happen, right? You've got a personal vehicle that you decide to use in your business. So the van had a basis of $13,000, but a fair market value of $6,000 on the date that she converted it. Because vans go down in, they go down in value. She plans to use it 100% for business. That's going to be relevant as well because not all assets are used 100% for business. So we have to also think how much, once we've figured out the depreciation, if it's not 100% for business, we have to take whatever portion is for business. So if it's half and half, we're only going to take half of what we've calculated. So the depreciable basis is $6,000, which is the lower of the adjusted basis or the fair market value at conversion. So the basis was $13,000, fair market value was $6,000. We're going to take the lesser of those two. mentioned here. If it had been used less than 100% for business, that 6,000 would be multiplied by the business use percentage. So if it was used 50% for business, which you can do that, you can depreciate it based on the proportion that you're using it for business, then she would depreciate $3,000 of that. Okay. Let's see. We're almost done with this. I do want to mention this because this one's kind of interesting. Because you think, okay, does this only apply to new equipment? What if I buy something from somebody else that they already fully depreciated, right? So I buy a building that somebody owned for 30 years and they rented it, and so they have fully depreciated it, right? So it has a zero basis to them because they've gotten all the tax benefit of that. Well, but I then buy it for $100,000. Do I still get to depreciate it? I do. I do get to depreciate it. So taxpayer buys an 8-year-old piece of equipment to use in a business for $4,000, they can still depreciate the $4,000 cost even though the equipment is used. So the theory is that the equipment has some useful productive life, otherwise you wouldn't be buying it, right? The depreciation is going to be based on the taxpayer's cost, doesn't matter what whether it's used or new. Okay, so whatever you paid for it. All right, question. That's basis. We're going to continue on Tuesday talking about the other 3 components. Okay? Any questions? Are you guys awake? No? All right.